Good morning and welcome to this Monday, March 9th edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, I probably should maybe rephrase that. I don't know if I can prepare you for everything that this day may hold. This is going to be good. This is probably going to go down as one of those historic days in the market. And I don't know where we're going to finish today, but I know where we're going to start, and it's not going to be very good. Lots of rough news over the weekend. We're seeing financial markets really around the globe taking a big hit. We're going to see circuit breakers triggered. They were already triggered in terms of just futures trading. If you've been watching the futures, you know that the Dow Jones has been stuck on about 1,255 for a while because they froze the futures. There is a trigger throughout the trading day that there's a circuit breaker that gets triggered if the S&P 500 were to drop 7%, and another one would trigger at 13%, another one would trigger at 20%. The first two, 7 and 13%, would result in 15-minute pauses in trading. And the 20% would result in the market just closing for the rest of the day. And these were circuit breakers that were set up back in 2013 as a result, really, of the flash crash that we saw back in May of 2010 when the market just, was free falling. And so they instituted a policy, circuit breakers, if you will, to just let everybody catch their breath if the market sells off. Well, we could have one of those days today. It's definitely looking pretty rough. Before I get into that, I do want to just mention we've scheduled an impromptu webinar for later today because there's no way I could possibly get through all of this in 30 minutes. There's a lot of things to talk about, but I do want to just point out that today we are going to be doing it for our members at EarningsBeats. So for those of you that are members, we'll be sending out room instructions later. If you're not a member and you'd like to come to this webinar, we do have a 30-day, it's basically a free 30-day trial. You get you'll be charged $7, but we'll refund it. So within a few business days, you'll get the $7 back on your credit card. So essentially, it's a no-risk 30-day trial to see if you like our service. But essentially, what we're going to do later today is, even though 2 weeks ago, I think it was Tuesday, what would that have been? February 25th, I think, Tuesday the 25th. Yeah, I think that was right. Tuesday the 25th was when I said, hey, the VIX has gone above 20. I don't like to trade when the market gets to this point. It's getting too volatile, and I just don't. It's never been easy for me to trade in a market like this. Because look at what happened on Friday. Going into the close, the Dow, I don't know, what did it gain 800 points in the last 40 minutes? And today, I'm going to go over and show you some pre-market stuff going on. But it looks like the Dow is probably going to close, or is going to open up around that 7% down level after gaining 800 points into the close. I would have thought, okay, if anything, Monday's going to open up because we're seeing a lot of buying in the afternoon. And what do we get? The exact opposite. So, if I had made that decision to trade and jump in on that strength on Friday afternoon, I'd be sitting here now with potentially a 7% drop at the open. And it's one of the reasons why I've said for many years, and I'll continue to say it, I don't like trading a high volatility market like this. To me, it's gambling. And if you catch it right, yeah, you can make a lot of money in a short period of time. But the flip side is you lose a lot of money in a short period of time. And I look at trading as a business, and my product is cash. And if I lose that cash, if you're out selling, widgets and somebody breaks in and steals 10% of your widgets, well, it's going to take a lot of widget sales to make up for that. And same thing with cash. If you lose 10% quickly, it's not easy to get that 10% back. So I would just prefer sitting things out. So later today, I'm going to talk about some things. Even though, I've been inactive in the market, it's not like I'm not doing homework. And so really what I want to do is kind of break down this breakdown. I'm going to talk a little bit about what's going on in the market, and really highlight some of the things to watch for. I'm going to talk about some of these previous, really high volatile periods and what they've taught us. It's really important to learn those lessons, because, making a mistake once or twice is one thing, but to keep making those same mistakes is really not excusable. And so we want to talk about some of the things, if this is new to you, if you haven't been in the market before, the one thing I would say is, hey, learn from it, because the stock market's a great way to build wealth over time, but there are things that you have to learn about the market. And one of those is when fear ramps up, the market is completely irrational. You can sit back and say, well, this company's growing earnings at such and such. Why is it getting hit? It doesn't, it shouldn't even be impacted by the coronavirus or the excess supply of crude oil. Why is this coming? The market doesn't care. When the market gets in this mood, everything sells off. So anyway, we want to have this special event later today, talk about some of the things that we do behind the scenes, under the surface, when the market is doing this, because we're trying to identify some of the best areas to invest when the dust settles. And there will be some great areas, and the dust will settle. Where it settles, when it settles, is it going to settle later today? Is it going to be next week, 2 months from now? I can't answer that. But the dust will settle, and there will be some great opportunities out there. So we've got to start preparing for that now. We don't wait until the market reverses a couple of days and then say, oh, I better jump into a couple of stocks. That's not the best way to plan as we move forward. So I'm going to talk about some of the industry groups that have really begun to show some nice relative strength, where the market, even though everything's kind of coming down, there's still some areas where we're seeing money rotate. So we want to talk about that. Identifying the best stocks within those groups. Earnings still matter. In fact, Bank of America came out this morning and said they have not seen a better argument for stocks over bonds since I think it was back in the mid 1950s. This is the best opportunity they've ever seen for choosing stocks over bonds. Now, again, when the volatility index is, well, we closed at 40 something, we're probably going to be 60, 70 or something at the open today, I'm guessing. But, not today. I wouldn't. Well, actually, I shouldn't say that. I mean, if you're thinking about getting in, you could certainly, at today's open, with everything being so panicked, starting to build a position with a VIX up in the 60s or 70s probably isn't a bad strategy. You just have to kind of go in holding your nose, because anything goes. Maybe the market hits the 7% trigger, maybe it hits the 13% trigger. Who knows what's going to happen today? There's a lot of fear out there, and it's being fueled by a lot of things. Some of it is reality, some of it is not. And so, but we still have to deal with it just the same. I want to talk about manipulation. I'm not going to go into a whole lot of details, but I will say that there are a lot of buyers in this market, believe it or not. And I'll explain what I mean by that later. Reviewing the extraordinarily high VIX levels. Talked about that. I also want to talk a little bit about Fibonacci. Fibonacci, I don't use it very often because it's just something that, from a very short-term trading perspective, which is what I focus on primarily, you don't expect retracement levels to be hit quickly. But when you're in a high VIX environment like this, I think Fibonacci can provide us some really good information. So we're going to talk a little bit more about Fibonacci. I'm going to talk a little bit about it today if I have time in the show. And then I want to talk about one technical indicator later today that really is telling me that there is institutional accumulation taking place while everyone else is fearful and bailing on this market. Don't see this very often, but I'm going to talk about that later anyway. So if you're interested, you can go right in here. You can click on the trial. It sets you up. Basically, it's $0. You get charged $7 again, but you'll be refunded. Come join us. I think it's going to be a great event. Maybe try to put a little calm and sense into what we've been seeing in the market, and really sit back and try to prepare for some great opportunities that I think are going to be right around the corner. Okay, let's talk about the market. Well, let's first start with Friday. Things are going to look a lot different this morning than they closed on Friday. But you can see hollow candles throughout the major indices, meaning that we saw closes above the opens. And we've seen that a few times here of late, even when we get these big down days. I think 4, you can see here now, on the Dow, 4 of the last 6 days have hollow candles. And actually, if I click on that, we put in the diamond, because the diamond and the Dow don't open the same. Yeah, it's still four hollow candles, 4 big hollow candles, though, and 2 red candles. And we don't know what kind of candle today. We're going to have a huge gap down, but we don't know what's going to happen after that. So anyway, those are just some things to be thinking about, that the market, even though it's gapping down, we do see recovery. We've seen 4 solid hollow candles out of the last 6 days, and we'll have to see what the market does today with this big gap down. But we did see the Dow down, finish down about 1%. S&P was down a little bit more, down about 1.1 3/4. NASDAQ down close to 2%. Same goes with the mid caps and the small caps. Mid caps and small caps, you can see the mid caps actually put in a lower low. Same with the small caps below that late February low. The other major indices did not. So the relative weakness in mid and small caps continues. Even, it was bad during the market while the market was going up, and it's continuing with the market going down. These are 2 groups that have been kind of shunned by Wall Street. As far as looking at the various sectors, you've got energy breaking to new lows, down 5.6% on Friday, and it is going to be a rough day for energy today. Crude oil prices getting absolutely clobbered, and I'll talk about that in just a minute. As far as the other sectors go, you can see financials. Of course, the 10-year Treasury yield. I'm not sure which one's going down faster, crude oil prices or the 10-year Treasury yield right now, but both are tumbling very rapidly. And when the yields are falling like they are right now, it's not good for financials. And you can see financials and energy both have put in new lows, kind of matching the small and mid caps. Materials weak, technology weak. Both of these, though, hanging in above those February lows, probably not at today's open. But anyway, all these groups down more than 2%. The best group on Friday was healthcare. Healthcare was only down 0.5%. And on a relative basis, healthcare is where a lot of money has been rotating toward. And I've talked a lot about the improving biotech sector. I believe when we come out of this, I think biotechs will be one of the better areas for the market in 2020. And so I'm not at all surprised to see this group holding up better on a relative basis. Okay, let's talk a little bit about the 10-year Treasury yield, because you can see here it is down on Friday. It was down to 0.70, 0.71, down 22 basis points. Let's get an update here so you can see what's going on now. Look at this move today. It is down 29 more basis points. We are currently at 0.42. We had gotten down earlier, and this only goes down to 0.39. I think it was down even further than that overnight. But it has been a wild, wild ride in the treasuries. Lots of folks bailing and moving into the safe treasury market. The good news, if there is good news, at some point when things settle down, there's going to be a ton of money rotating out of treasuries. Remember, when the yield starts rising, when we see these moves up in the yield, that's when the equity market gets its biggest push. Well, we haven't had any help from the treasury market in the past few weeks, really since we broke down mid-February. And so eventually, I think this now marks the 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, the 13th consecutive day on the yield dropping. And it's just looking very capitulatory in nature to me. When we see these huge drops like this, after already going down 11 days in a row, then getting 2 more like this, I don't know how much further we go. I believe that we are very close to capitulation in a lot of these financial markets. But if you're off by a day, if you thought Friday was capitulation, look what happens when you're off a day, or maybe it's 2 days or 3 days. So that's what's really hard about a high VIX environment, is trying to time exact bottoms. Looking at the 10-year Treasury yield, just to give you a little longer term perspective, this is going back 15 years on the monthly chart. And you can see these big moves. Now, this isn't completely unprecedented. We saw 2011. We went from about 3.7% in just a little over a year down to 1.4%. And some of these drops in just a couple of months were very steep. You could see 2008, of course, with the financial collapse. These 2 months, October and November, excuse me, November and December, I believe, massive drops in the 10-year Treasury yield, and that coincided with a big drop in equities. But when we started to move back up again, that helped to fuel the bottom. And by the way, I don't know if this is irony or not, but today, March 9th, this is the 11-year anniversary of the March 9th bottom in the stock market back in 2009. So pretty interesting day from that respect. You know, and when you look at the long-term chart, yes, the equity market's been hit hard. It's going down again today, but I believe we remain in a secular bull market. It would probably take a confirmed break of the lows in the fourth quarter of 2018 before I would begin to believe that this could be the end of a secular bull market. I'm not even sure if that would do it, because I really believe that as soon as this dust settles, no matter how bad it gets, I think there's going to be a very big snapback rally that puts us right back into the uptrend. So, but the key here is that if you are on the sidelines, the timing of trying to get back in is going to be critical. And if you're in the market and you're long-term, then you're long-term. Don't try to time the market. It's the worst thing. You know, I know that 2008, as bad as it was, it got so depressing because it lasted so long. It was like, we're never going to get out of this. And then banks, you know, were under pressure. Some banks collapsing, Lehman Brothers. I mean, that was really the depths of despair back in 2008 into 2009. And that was a secular bear market that really was wearing on everyone. I mean, 2 weeks ago, 3 weeks ago, it was like nothing was wrong with the equity markets. We were an all-time high. This is completely different than a secular bear market that wears on for many, many years. So let's get through this, and hopefully very shortly, we will see capitulation and maybe a resumption of the longer-term trend. All right. This was a spider back in 2010. I just wanted to mention, this was, you know, I talked about the circuit breakers. Here was the day back in 2010 where the spider dropped from $96 at the high of the day down to 86 and change. It was down more than 10% in one day. And so that was actually the day that ended up triggering these circuit breaker laws and why we have these pauses in the market. All right, now I'm going to go into some things here just to kind of bring you up to date. I mean, I'm not going into earnings and all. Earnings right now, believe it, well, you probably know, earnings don't matter right at this moment in time. The market could care less about a company coming out and reporting strong earnings because the market looks ahead 6 to 9 months, and right now it's not liking what it's seeing. And so as long as it's going to panic looking ahead, you know, somebody coming out with a strong earnings report really doesn't matter. So let's talk about some things. The price war for oil. I'm going to first bring up the crude oil price chart. And you can see back at the beginning of the year, first week of January, we were up near $66 a barrel on oil. We closed last week at 41. And last check, crude oil, pulling it up right now, it's $31. It's $31.92. It's down $9.36, down 23% today. Now, there's a number of reasons for it. There's definitely a price war. OPEC did not agree to cut production. So as a result, we've got too much supply, and with the coronavirus and all the economic worries, we've got less demand, people starting to work from home, not going into work. So there's a tremendous imbalance right now between the demand and supply. We got too much supply and too little demand, which is driving prices straight down. You know, OPEC is going to have to act. I would imagine that if prices get low enough, they will act to try to bring prices back up and stabilize the action. But right now it has been in free fall, and crude oil prices, you should start seeing some pretty big drops at the pumps based on this. I know there's still other costs involved, refining costs, delivery costs, everything else, but the actual price of crude oil has dropped so much that I would be expecting some pretty big drops at the pump. All right, next up, what can we talk about? Treasury yields, talked about Treasury yields, but I will say that the UK 10-year Treasury yield went negative. It's one of the latest to move into negative territory. And believe it or not, I mean, we were thinking, maybe I was thinking anyway, that no way the 10-year Treasury yield would go negative. Well, after this drop, we're not that far. And we are back to 0.46 coming off of those earlier lows on crude oil, or on the 10-year Treasury yield. So we'll see whether or not we can begin to bounce. If yields start to bounce off of this and we really start seeing a big move back up, that would help the equity market find a bottom, because the yields moving up means money's coming out of treasuries. If money's coming out of treasuries, tends to look for equities. What else do we have? Well, we've got gold flat, silver down 2.5%, copper down almost 3%. The Tokyo Nikkei down over 5%, China Shanghai down 3%, the Hong Kong Hang Seng down 4%, Australia's ASX down 7%, South Korea Seoul Composite down 4%. Earlier this morning, and I'm going to try and get you an update on these, the German DAX was down 7%. Let's see where it is. It's down 7.59%. The FTSE down 7.67%. The French CAC down 7.78%. The stock 600 down 7.25%. I mean, you can see that it is just get out of everything. It's not, picking this area versus that area. It's just everything selling off. And that's likely to hit our stocks the same way. And one of the things you can do, you can't look at the futures right now, but what we can do is look at the SPDR, the SPY, to see how it's trading in pre-market, down 7.34%. The QQQ down 6.97%. The, I don't know, what's the diamond for the Dow, down 7.1%. It is indiscriminate selling again. Everything's just being sold off. And what that means is companies that actually show relative strength are the ones that are likely to bounce the best when we do recover. So it's really important to be looking and doing your homework to find some of the areas of the market that are showing relative strength. Not everything is going down. We'll go down 7% at the open, but we will see some going down even more. So let's talk about some individual stocks. How about the cruise lines today? They got more bad news. The CDC came out and updated its website that U.S. citizens should not travel by cruise ship. Okay, that probably goes without saying. I think most everybody had figured that one out on their own. And as a result, many of these cruise lines have just absolutely been crushed. I mean, this is Royal Caribbean. You can see it was $135 in mid-January. After this morning's 13% drop, we're looking at it being down to $56.60 from $135. And if we look at some of the others, CCL, which is Carnival, down another 11% today. Norwegian, NCLH, down 12.5%. And we could go probably through all the airlines. I'm sure they're all getting hit pretty well. Well, 6%. That's actually better than the market on Delta. United down 4.5%. Not as bad as some of the cruise lines, that's for sure. How about energy stocks? I was looking at ExxonMobil, and I'm going to try and pull this up on a separate computer here while you're looking at this. But ExxonMobil down another 15% today. And I just wanted to go in and tell you what their yield now is. Now, of course, they can always cut their dividend if things are, crude oil prices get so low and they can't make the money they want and they can't afford to pay the dividend, they can always cut. But they are yielding, before today's drop, they're yielding, it's $3.48 is their dividend. So they were yielding 7%. At $40.50. That's probably getting up over 8% on a dividend yield on ExxonMobil. So, I mean, ExxonMobil is getting hit with crude oil prices and all, but if you're investing and you could buy ExxonMobil that's currently yielding 8%, or you can buy a U.S. Treasury that's going to pay you 0.4% over a 10-year period. You know, this is what Bank of America is getting back to. You know, the Treasury market, the bond market versus what we've got in the stock market, I don't know how anybody can make the choice except out of fear that you just believe the market's going to collapse and go to zero. Trust me, if it goes to zero, there's going to be a lot of fallout in other asset classes. It's not going to be pretty. And I'm much more of an optimist to think we're heading for something like that. So I'm looking at this as a tremendous opportunity. That it's really comes down to timing and trying to find that capitulatory. I wrote an article the other day that, you know, market makers are buying the kitchen sink. You know, you're waiting until that kitchen sink gets thrown in. That's when the market makers are buying, and that's what we need to be looking for, and trying to get in with the market makers instead of being on the other side, being panicked out by the market makers. And when I say that, market makers are on the other side of trades. When we get days like today, they go on vacation. You think they want to commit their capital when everybody in the world wants to sell stocks? Of course not. That's why we keep getting these huge gap downs. And I'm going to talk a lot more about that later tonight. Let's see, what else do we have in a couple other stocks before we do the three you must see. And honestly, even the three you must see, I'm not sure if that's really worth looking at the way things are going. But let's take a look at a couple of other interesting names. Costco. So they came out in areas around the country and said they're free samples. If you ever go into Costco, they stand at the aisles and they'll give you free samples of some of their food. Well, they're discontinuing that because of the coronavirus. Stock down 16%, but still continuing to outperform today's overall market. And you can see this is one of those stocks that I think is actually performing really well. They're getting hit, but they're performing really well relative to the overall market. So this is a stock coming out of this that I think could be extremely strong. Amazon, let's see what Amazon is doing today. So Amazon said that a lot of its employees can stay home and work from home, and you know they're just providing a lot more flexibility. Stock down $131. What's $131 among friends? Microsoft down 7%. Tesla, how about Tesla? Some of the bigger names, just give you an idea. Tesla down 14% to 600, down below the low at the end of February. Tesla is one that I really like, but we're going to have to wait for everything to calm down. I expect when it does, you're going to see a very quick move higher in Tesla. Let's see, what else? Uber came out and announced that they were trying to put something together, a fund together for their drivers that come down with the coronavirus as a result of being out there lifting, giving folks rides. But the stock down 10.8% today. And then how about Facebook? Facebook being sued. What else is new? Being sued by Australia's privacy regulator for sharing personal data without users' knowledge. That sounds familiar. Stock down 6.25%, down just under 170. So one more look at that spider, and we are currently down almost 8% on the spider as we head toward the open. Let's wrap up this mess of a morning with the three you must see. I'll just go through these kind of quickly. First one is Deere. And basically what I wanted to do with Deere was, and Deere, by the way, down 152.15, down 7.25% today. It did hold on to this support level down around 152, but we're probably going to be back down there challenging it again today. I would be watching this level. A lot of buyers. Look at the volume pickup. A lot of buyers on that hollow candle. So Deere seems to be accumulated. Only one big red candle in the last 6 days. So I think this is a stock that's being accumulated and could be pretty strong when we come out of this. Another one I wanted to point out was DOMO. This was actually one of the big scooter movers. And you notice here that the stock actually gapped down and was down 6% on Friday. I just wanted to point this out just to let you know that just because a scooter mover goes up doesn't mean the stock price has to go up. It's being based on rate of change. So I have a feeling that one of these gaps came into play on one of its rate of change calculations, and probably this one back here, so that it was looking at this low versus this close over here in calculating the scooter. And then all of a sudden we got this big gap down. Now it's looking at this versus this and saying, wow, the rate of change just improved. Well, it did, but the stock price is going down. Something to think about. And then the last one for you is APA. This is just a poster child for many of the energy stocks out there. If I can get this to come up here for us, come on. Now the market's open. There's probably so much activity right now looking at charts. Well, I'm not going to be able to get the chart up right now. But what I would say is that APA, like all energy stocks, breaking down to new lows. I just think it's too early on these stocks. You know, maybe if you're slowly getting into them, you can start buying. But these energy stocks are going to be under tremendous pressure today. All right, that is it. Again, do have a webinar later today. So if you're interested, go in. You can go to EarningsBeats.com right here on our homepage. Click on the 30-day trial. It's essentially free. You will be charged $7, but that $7 will be refunded to you. You can try our service out for 30 days. I think the market guidance is worth its weight in gold. Everybody have a great day. Be back on Wednesday here for Trading Places Live. Tomorrow I will be at Stock Charts TV with Trading Places Live beginning at 9 a.m. Everybody have a great day. See you tomorrow. And for those of you that are members of EarningsBeats, see you later today. Happy trading.